In today's episode, we're opening up the listener mailbag to answer questions specifically around taxes, tax planning, and year-end planning. Listen in as the questions and responses may help you keep more of your hard-earned retirement savings and hard-earned income in your accounts versus giving it to the IRS.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Retirement Show, all about your life, your money, and your taxes. And that's going to be our focus today is year-end planning and year-end tax planning. As I mentioned last week, this week and the next couple weeks, we're going to open up the listener mailbag, but specifically be pulling questions out in regards to taxes and tax planning and year-end planning. You see, last week was all about strategies, all about opportunities. Now we want to take that and put it into people's situations. How do we take advantage of these strategies? Where do these opportunities actually come up in someone's specific question? So listen in as I find that you'll probably be able to take wherever you're at in your shoes today and then kind of marry that up to some of these different questions to see if you can take those strategies and utilize them as you might find yourself in a similar situation to the people here that are writing in. Now, for those that I haven't met, my name's Scott Searens. I'm your host. My goal is to help you thrive in life, wealth, and retirement. And our goal over the next few weeks is how do we keep more of your hard-earned retirement accounts, hard-earned retirement income? How do we keep that in your accounts versus giving it to the IRS in the form of taxes? So we've got some great questions that came in. We've got questions that came in regards to Roth IRA versus Roth 403B. And instead of 403B, you could also put in there 401k, Roth 401k, Roth 457. But this question that came in really hits on both year-end planning as well as tax planning. The next question that came in, we're going to talk about whether or not the HSA is a good fit for our particular situation. And our last question from Dan that came in is how to reduce taxes on his $1 million plus IRA. And we'll go into the specifics in his question and his situation, and then talk about the strategies that Dan needs to go through and utilize specific to his question there. So let's start with our question from Mayuki, who says, how are the Roth IRA and Roth 403B different? And then which is better? Is it better to max out your Roth IRA or better to max out your Roth 403B? Well, Mayuki, great question. And like I mentioned, this question here has a lot to do with year-end planning, but also a lot to do with tax planning and what your future taxes could potentially look at. Now, in both of these here, you mentioned the Roth. Here's how I'd like to kind of think about the Roth. Have you ever done a project or worked on something like really, really hard? I mean, you put a lot of hard work into it, and it probably wasn't like hard work that you just put in, one day and it was done. But I mean, hard work that you put in day after day after day or year after year. And you look back at that project and at the end you're like, wow, look where this got me. Look what this did for me. And I'll tell you what, the Roth is kind of similar here, Mayuki, because as you had mentioned, the Roth, you're going to pay tax today. So you're doing a lot of hard work today. You're paying tax today on your money. But that money then, it's going to grow tax-free, and you can make withdrawals from it tax-free in your future. So just in case somebody else was listening, they're like, why are we just talking about the Roth? What is it about the Roth, I guess, that has so much impact? Well, it's that hard work today, again, pay off for your future, because when that money grows, you now have tax-free money for your future. Okay, let's talk about Mayuki's question here and break it down into a couple different parts. She mentioned Roth 403B. Well, that could be Roth 403B, but I just want to, for other people that are listening, looking to get benefit out of this, Roth 403B could also mean Roth 401k, Roth 457. That grouping right there is your company-sponsored retirement plan. So instead of saying Roth 403B, from kind of this point forward, I'm going to say, hey, your company-sponsored retirement plan, which could mean Roth 403B, Roth 401k, Roth 457. And she said, hey, what's the difference between that, the company-sponsored retirement plan, and the Roth IRA? So let's start there. I realize this doesn't have tax planning in it just yet, but we'll get there. Follow along with me. Okay, so Roth 403B, or that company-sponsored retirement plan, versus the Roth IRA. Well, a few differences. One are the contribution limits. So in this year 2023, in the company-sponsored retirement plans, you can put into it $22,500. If you're age 50 plus, you can then put into it $30,000 a year. Whereas the Roth IRA, you can put $6,500 into that each and every year. And if you're age 50 plus, well, then you can put $7,500 into it a year. Now, the other part here is that the Roth 403B does not have any sort of income limits. So you can make as much as you need to make, or that you're making at your job, and you can always contribute to your company-sponsored retirement plan, 403B, Roth 403B, Roth 401k. However, that Roth IRA actually has income limits. And if you make above those income limits, you're actually not able to contribute to your Roth IRA. For instance, if you're married filing jointly and you make over $228,000, or if your modified adjusted gross income is over $228,000, you're not able to put into your Roth IRA. If you're single and your modified adjusted gross income is over $153,000, you're not able to put into that Roth IRA. So company-sponsored retirement plan, no income limits. Roth IRA, income limits. Another thing here is your company-sponsored retirement plan, you might get a company match. And so you want to make sure that you're getting that, which I'll call free money here in quotes, right? That free money that the company is going to give you for putting into your company-sponsored retirement plan. Whereas the Roth IRA, you're not going to have any sort of company match. Now, here's another thing to think about. You can actually do both. So let's just say you're maxing out your company-sponsored retirement plan. So from a tax planning standpoint, why are these accounts important? Well, if you feel like your taxable income is going to be higher in the future than where it's actually at today, then putting into this, you're going to pay tax today. It's all going to grow tax-free if you have it invested, and then you can take it out tax-free in your future. So in your future, where you think your taxable income might be higher, this will be tax-free money that you can take out. You don't have to worry about income taxes on it. You don't have to worry about it putting you up into another tax bracket. So that's the power of focusing on the Roth, whether it be 403B or Roth IRA. That's the power on focusing on that today. Which is better? Well, I guess it depends. It could depend on how much income that you have coming in. It could depend on the investment choices that you have available to you. So in your company-sponsored retirement plan, maybe you have some great investment choices available to you. Maybe you have investment choices that aren't so great. Well, then your Roth IRA might be better because you'll have the world of investment choices available to you. Maybe in your company-sponsored retirement plan, there's fund fees, plan fees that are high. If so, well, then maybe the Roth IRA will be better. But remember, the Roth IRA then also comes with limits of how much that you can put in. And one thing where I was going earlier is that you can actually do both. So if you're looking for more ways to get more tax-free money for your future, guess what? If you're age 50 plus, you could put $30,000 into your company-sponsored retirement plan, into that Roth 403B, 401k, 457. And on top of that, again, based on how much income you have, you could put another $7,500 into your Roth IRA. So from a year-end planning standpoint, what are you doing to be able to maximize each of these before the end of the year? Hey, if you have only got $20,000 to put away, then which one's better might depend on, well, you can only put $7,500 right into the Roth IRA. So that's where you cap out on that one. Then your focus has to be the Roth 403B after that. Let's just say you only have $5,000 to put away for the year. Which one is better? Well, that might come down to, are you getting a company match? If so, focus on the Roth 403B. Are you not getting a company match and the fund fees are high and the plan fees are high and the investment selections are poor at your company? Well, then you might want to focus on the Roth IRA. So the focus is all going to be dependent on these items here. So as I was going through, maybe you're creating yourself your own little T chart, right? Or comparison chart, writing those down on each side. So then you can get done and look at this and go, oh, hey, look at this comparison chart. I'm going to focus on the left-hand side, which is my company-sponsored retirement plan. Or, I'm going to focus on the right-hand side, which is my Roth. But just to wrap up, sorry, I'm kind of going in a lot of tangents here on your question here, Mayoki, but I hope you're finding it all to be of value and benefit. Just to end up, from a tax planning standpoint, it all is going to help you with that tax-free growth. So if you feel like your taxes are going to be higher in the future, great job just first off on focusing on the Roth. Pay tax today at what you feel is going to be a lower rate and get all that tax-free growth. From a year-end planning standpoint, you have to do all of your company contributions before December 31st. So if you need to max out that Roth 401k, you got more money that you can save. You can put that $30,000 away if you're age 50 plus. Well, now's the time to crank up those contributions to get that maximum before the end of the year. So, hey, hopefully you found this to be of value and benefit. And I tell you what, I know a lot of other people out there have Roths available to them in their company-sponsored retirement plans, or have a Roth IRA available to them in the retail market. So I'm guessing, Mayuki, you're not the only one with that question on your mind, and hopefully others found it valuable as well. All right, our next question comes from Mary. Mary says, I'm 59 years old and plan to retire around age 65 or 66. I make over $150,000 a year. My company offers a high deductible health plan and health savings account. Should I consider switching over to this health plan? Are there any benefits since it will only be for 6 or 7 years until I retire? Okay, so first off, Mary, glad that you're looking into this. We talked about this a little bit last week too, right? That health savings account. This is a triple tax advantaged account, and I'm going to get there and I'm going to explain the triple tax advantage benefits of not the high deductible health plan, but of the health savings account. So we'll get there. So first off, I'm going to talk about the benefits, and then second, we'll talk about the thought process that you should go through to understand if you should switch, right? So not everybody should necessarily switch to the high deductible health plan and health savings account. It's not for everyone, but for some people, it is a great fit and it gives you some really good tax advantages to take advantage of. So first off, let's talk about the benefits here. Just so everybody's aware, a health savings account, the advantages don't necessarily come with a high deductible health plan. Now, there are some advantages to that. Usually you pay lower premiums for your health insurance, but you also have a higher deductible, right? Trade-offs there. We'll talk about that towards the end of this question. But there's benefits usually if your company allows you then to put into a health savings account. And let's just talk about the benefits of that health savings account. When you put money in, you actually get a tax deduction for doing so. Now, for instance, this year, 2023, if you're married filing jointly, you can put up to $7,750 into a health savings account. And if you're age 55 plus, you can do another $1,000. So that's $8,750 married filing jointly over the age of 55 can put into this account. First benefit, the tax deduction. Now, a lot of times people think, oh, well, I can't itemize my taxes. The standard deduction's so high. I won't be getting any sort of deductions on my taxes. The tax deduction for the health savings account is actually in addition to the standard deduction. So you're going to get the tax deduction for using this health savings account. For example, let's just say you're married filing jointly, you have $150,000 of taxable income coming in, and you did the maximum to the health savings account, that $8,750. Well, now instead of $150,000 of taxable income, you'll have $141,250 of taxable income. See how it lowered it there? Reducing the taxes. On top of that, you'll still get the standard deduction or the itemized deduction that you're able to take. So first benefit is the tax deduction. Now, Mary here, and I guess income comes into play on this, but really doesn't either. Mary's got $150,000 of taxable income coming in. She's got a nice high income coming in. Anywhere that you can get tax benefits when you've got a higher income coming in can be a great benefit. So utilizing this, Mary, could potentially be a good benefit for you. Again, should you switch? We'll talk about that a little bit later. Okay, so that was, I said triple tax advantage benefits, right? That's number one. Number two, second tax benefit of this account, it grows tax-free. And I know what you might be thinking. A lot of times when I bring up HSA, meeting with new people, they're thinking, oh, wait, is that the account at work where you use it or lose it and it goes away if I don't spend it on medical expenses and I never know how much I'm going to spend, so I'm not going to use the account? Totally different. What I just talked about there, that's your FSA, flexible spending account. What we're talking about here is the HSA, health savings account, and it's not use it or lose it. It actually carries over year to year to year to year. Well, you have the ability to carry it over, and you have the ability to invest it. And you can invest it for growth, just like you can invest your IRA or your 401k or your Roth 401k. You can invest this to grow just as well. And all of that growth is going to be tax-free growth as long as you use this money in the proper manner. So benefit number two, tax-free growth, the ability to invest it in tax-free growth. Benefit number three, the triple tax advantage benefit. I know what you're typically thinking. Hey, on my 401k, I get a tax deduction today. Yeah, it grows tax deferred. But then when I use it, I have to pay income tax. There's got to be a gotcha on this account, right? Well, there's not. And that's why I'm saying this has the triple tax advantage benefit. You see, on this account, you can use the money tax-free as long as you're using it for qualified medical expenses. Qualified medical expenses. Now, you can go to the internet and find the long list of them, but for example, you can use it to pay for Medicare. You can use it to pay for doctor's bills. You can use it to pay for your prescriptions at the pharmacy. Qualified medical expenses, it covers a lot of ground on what you're able to use this money to pay for tax-free. As long as you use it for those expenses, the money then gets used tax-free. So imagine this. In retirement, you're going to have to pay for Medicare Part B. Right now, this year, the base payment for Medicare Part B, $165 a month. Let's just say then you decide to go with like a Medicare supplement, and you've got a prescription drug plan. And let's just say all of those add in. I have no idea. We're just making up a number today, another $150 a month. So in your retirement, just for Medicare, you got $315 a month for Medicare Part B plus supplements plus prescription drugs. Take that times 12. Now you got $3,780 a year that you're paying for Medicare. Well, where are you getting that money to pay for Medicare? If you don't just have it sitting in a savings account, you might have to be taking out of your IRA to be able to pay for your Medicare benefits. Let's say you are taking from your IRA. Well, IRA, when you take that money out, guess what? It's taxable. Let's say your effective tax rate's 15%. Well, 15% on that $3,780 is $567 a year that you're paying in taxes just to be able to pay your Medicare. Say over 10 years, that's $5,670. So that's one way to think about it, taking it out of your IRA. Or the other way to think about it is what Mary's thinking about here, which is planning in advance and saving into her HSA. So instead of Mary paying that, again, just estimated and hypothetical number of $5,670 in taxes, guess what? If she had saved all of that money, that 10 years worth of payments into her HSA, she now gets to pay for all of that Medicare tax-free. Tax-free. So that's the benefit. And just to remind you, it's not use it or lose it. You can roll it over year to year and you can invest it. So one situation, you pay for Medicare, you pay for your health bills. And where are you going to pay it from? Most likely your retirement savings that you're going to have to pay tax on. Or you start saving today into the HSA, and now you're able to pay for all the qualified health expenses tax-free. So hopefully you see the tax situation wrapped around this and how it can benefit you from a tax standpoint. Now, to Mary's question, should she make the switch? Well, one, there's the tax benefits, so you have to kind of consider all of those. But then there's the questions on what's Mary's health like? It really depends. Should you switch or not is going to depend on your health. What are your doctor's bills? What are your prescriptions? How much are you paying out in health each and every year? Does it make sense for you to then go with this higher deductible account? Because if you're not healthy and you're paying a lot out each and every year in medical expenses, it might not make sense for you to go to this higher deductible health plan. So what's your health like? Compare where you're at today versus what it would look like if you went on a high deductible health plan. At the same time, you need to compare those premiums because your premiums should go down with a high deductible health plan. And then you want to add in the tax benefits of this other plan. So kind of 3 things to look at to make that decision whether or not you should switch. A lot of it wraps around that health question there for you, Mary. So hopefully we've shown you not only the tax benefits here, the tax advantages, but we also want to bring it back to you and to your specific situation. And you still need to do a comparison based on health to see if it makes sense to switch. Mary, thanks for sending in that question. I know lots of people have those types of plans available to them in their company, or at their company, I should say. So I'm sure a lot of them have that same question on their mind, whether or not they should switch over to that high deductible health plan and take advantage of that health savings account. All right, let's move forward to our last question from Dan on how to save money on his IRA. But before we get to that, one thing I want to make you aware of is our free guide to unlocking hidden tax savings opportunities. What it is and what it does actually is provide you a guide of actions and strategies that you can utilize specific to your situation. And what this actually means is it's going to show you and help you understand how to keep more of your hard-earned retirement savings, like Dan here, how to keep more of your hard-earned money, like Mary, in your pocket, in your accounts, versus giving it to the IRS. You can get our free guide at lifemoneyshow.com/taxes. Again, that's lifemoneyshow.com/taxes. All right, let's move on. Like I said, our last question from Dan. Dan says, I'm in my early 60s. I've got $2 million saved. 1.7 million of that is in IRAs and 401ks, and the rest is in a brokerage account. How do I keep from giving a huge portion of it to Uncle Sam? Well, the first thing here, Dan, is we'd want to do a tax projection. A tax projection to understand where you're at today and where you're going to be at in the future when it comes to taxable income. I talked a little bit, if you want to go back to last week's episode, I went in a little bit more in depth of what a tax projection is. But Dan, just from a snapshot standpoint, and you didn't tell us how much you're making today, so we're going to have to give some thoughts and ideas around your question here to help lead you in the right direction. So from a tax projection standpoint, let's do a snapshot. Let's just say you're age 80 and you still have that 1.7 million in your IRA, right? You got some growth, but you're taking the required distributions. What does that put you at for taxable income in your future? Now, you're going to have to substitute your own numbers here, but let's just say at age 80, you still had 1.7 million in your IRAs. That's going to be a $96,045 required minimum distribution. Oh, that's right, Dan. You said you had a lot in your IRAs, 401ks. Anybody with anything in their IRAs, 401ks, starting in your 70s, you have to take those required minimum distributions, the forced income that you have to take out of those accounts. And the money that you take out is going to get taxed, adds into your taxable income. So this is where the tax projection comes into play. A lot of people say, well, I don't need the money. Let it in there. Let it grow. Doesn't matter. You need to take it out. Otherwise, you're going to get penalized. So back to our projection here, let's just say age 80, still have that 1.7 million there. Guess what? That's just call it $96,000, $96,045 taxable income. Let's say Dan's married and him and his spouse, they each have a $3,000 per month Social Security coming in. Well, that's $72,000 a year in Social Security based on all the taxable income from your IRA and 401k. Guess what? 85% of that Social Security is now taxable. So that's $61,200 of more taxable income. Dan, by the time we get done with all this, next thing you know, you've got $157,245 of taxable income coming in your future. As I mentioned, substitute in your own numbers. But this is the importance of having a tax projection. So Dan, and let's say he was married here, Dan and his spouse would fall in the 22% tax bracket. How do we use this? Well, we now need to compare this to where you're at today. Maybe Dan's still working. We don't know. He didn't provide that information, but let's just say he is still working and he's making the same or less than the 22% bracket today. Well, in that case then, Dan, if that's your case, I'd say, hey, you might want to think about switching over to the Roth 401k. Or you might want to just reduce your contributions to the company match, but then make your extra contributions to the Roth IRA. You see, if you're making the same or less today, paying tax today would be in your best interest because we just figured out with some very quick math that your taxable income and your tax bracket will be higher in the future. The other thing to think about is the Tax Cuts and Jobs Act. That's going to expire at the end of 2025. So I know I said 22% bracket. Well, that's really today. But if they let the Tax Cuts and Jobs Act expire, put you in the 25% bracket in your future. Now, you might look at all this and go, wait, I'm making way more than that today. Well, then great. You got to keep contributing to your IRAs and 401ks because you know what? Looks like your taxes will be lower in your future today than where you're working right now. Now, let's just say you're retired and your taxable income drops because you've retired. You no longer have that company paycheck coming in. Now, the only income that you have coming in is your Social Security and what you're taking out of your IRAs. Well, if that puts you at a lower taxable income, lower tax bracket than $157,000 in our example here in the 22% bracket, then guess what? It might be a really good time to start doing those Roth conversions. Paying tax today to get your money in the tax-free bucket, get it out of the IRA into the Roth IRA in that tax-free bucket, letting it grow tax-free so you can make withdrawals tax-free. All right, Dan, we've got two more things that you want to consider in regards to your overall situation. You mentioned that you've got a brokerage account as well. $2 million saved, $1.7 million in the IRAs and 401ks. So that, I'm just going to assume, means $300,000 into a brokerage account. Well, the next thing that I want you to consider is your asset allocation. Where are you putting your stocks? Where are you putting your bonds? You see, in a brokerage account, you're going to get taxed on interest, dividends, and gains. Interest and short-term gains get taxed at ordinary income tax rates. Guess what produces interest? Bonds produce interest. Well, what do we know about your IRAs and 401ks? You're already going to get taxed at those ordinary income tax rates. So we could have bonds in your brokerage account causing interest, causing ordinary income taxes every year, or we shift those bonds to your IRAs and 401ks where you're already going to get taxed on at ordinary income tax rates. And instead, now we maybe put some stocks in that brokerage account to replace those bonds, right? So your bonds might replace some of the stocks in your IRA. Your stocks might replace some of the bonds in your brokerage account. And by doing that, and if you focus on long-term capital gains get taxed at a more favorable rate, long-term capital gains rates. Dividends, if they're ordinary dividends, ordinary income tax. Qualified dividends, though, get taxed at long-term capital gains rates. You see, making some switches there, we can help maybe keep that tax bill down each and every year. And then last, Dan did not mention here whether or not he's charitable. Now, he's not age 70 and a half yet to be able to take advantage of those qualified distributions, but he might, if he is charitable, be able to take advantage of donor-advised funds. Or he had mentioned he's got this brokerage account. Maybe he's got some heavily appreciated stock in his brokerage account. Well, he can donate appreciated stock to charities as well, and there's some tax advantages in regards to doing that. So to wrap up, what's Dan looking at here? He's got that $1+ million in his IRAs. Some questions that he wants to start going through is, first off, putting together that tax projection. Next, if he's still working, which is better? Roth 401k versus traditional 401k, Roth IRA versus traditional IRA. After that, should we start looking at some Roth conversions? After that, how about asset allocation? And then if he's charitable, there's some strategies there to utilize as well. Hey, I hope that you're finding these questions and the answers and the strategies, to people's situations helpful. Maybe you're able to say, oh, I'm in a similar situation to Dan, or I'm in a similar situation to Mary. My company has a high deductible health plan available, and take what we've talked about today and apply it to your situation. Apply those thoughts, apply those thought processes, understand whether or not you should take advantage of those strategies or not. If you found today's helpful, we're just going to be answering more questions from more listeners just like you in next week's episode, again, revolving around taxes, revolving around tax planning, and revolving around tax year-end planning. Hey, I look forward to answering more questions for you next week. If you've enjoyed today's episode, subscribe on your favorite podcast player. That way you get notified when next week's episode comes out. I look forward to our next conversation to helping you enjoy life today and being financially confident about your retirement.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.